Hi, good afternoon, everyone. My name is George Thomas. I'm part of Quantum Mutual Fund. I manage the Quantum Long-Term Equity Value Fund along with Christy. Uh, so, so I'll just give you a brief about what we perceive about markets and our bouquet of products to capitalize on the market opportunity. So before we get into the market-related topic, I'll just give you a quick introduction about who we are. So Quantum was founded in the year 90s by a gentleman called Ajit Dayal. And initial years, we used to provide research to foreign fund houses like Jardine Fleming and Hansberger Global Investors. And so most of our learnings, initial learnings kind of evolved in that period as a research house and equity research and fund management experience came out around that period. And in the early 2000s, we started accepting money from foreign institutions like endowments and pension funds, majorly out of the Western world. In 2006, we started Quantum Mutual Fund, where our longest product is Quantum Long-Term Equity Value Fund, which is managed in a value style. But of course, you know, the initial periods as the business was organically growing, let's say the priorities and the capital allocation was limited, and therefore in 2016, to increase our efforts on market efforts and things, and there was a regulation by SEBI which mandated a certain net worth by AMCs. We accepted some investment from Fairfax Global, which is managed by Mr. Prem Valsa out of Canada, and they have investments across multiple companies, including prominent ones like ICICI Lombard and stuff. So they hold about 49% stake in our company, and 51% is held by the founder and the senior management. So now coming to what we feel about the markets. So when we look at the market performance, ultimately what reflects in the market is how the underlying profitability and economics work of those individual companies. So this graph, it shows how the profitability and revenues have transpired in the listed space. And if you look here, meaningfully, if we see in the last 3 years, the profitability has improved quite substantially. So from where we were prior to 2020 and now, there is a substantial difference in how the earnings have panned out, and that's a similar case even in the sales trajectory. The net sales is indicated in that blue line, and those orange bars indicate how the profits have transpired. So few things have happened. The economy has become more formalized. There are more efficient companies in the system right now, and all the bad capital allocators and all of them have gone out of system, and therefore the productivity and things have improved meaningfully. But if you look at the last few quarters, what has happened is your sales growth or the top line growth has kind of moderated, primarily because there was very high inflation and that necessitated higher price hikes and stuff. But profitability kept on improving, primarily because the profit margins improved, the input prices kind of moderated, and things like that. So going forward, what we feel is the peak inflation is behind us. So companies may not want to take the price hikes to the quantum what they took in the last 2-3 years. And therefore, what would happen in that kind of a scenario is you would have better affordability for your products, and therefore the volume growth, or the companies have option to sell more volume into the market, and that will take care of the margins and things. So coming to the next slide. So this is how the market valuation have panned out over the years. So as you can see, the valuation is slightly above the long-term average, and since we have seen stellar returns in the markets for the last few years, and that is a very easy guess that valuation is above long-term average. But another thing to note at this point is even the earnings are kind of improving in an improving trajectory, and typically, and it's showing all signs of a classic earnings upcycle where the earnings growth can sustain for 3, 4, 5 years. And in that kind of a scenario, what typically happens is the higher valuation is majorly is explained or is justified by the earnings growth that could come in the next few years. And of course, there are pockets of overvaluation and pockets of where there is reasonable valuation. And if we were to look at sectors where we can expect better chances of better returns and or where market is not factoring in too much of good news. So in this chart, there are two bar graphs. One on the left shows how analysts have changed their earnings estimates for different sectors for the current year. And on the right chart, so on your right, you would see those index returns of different sectors. So if you could see those two highlighted circles that stand for IT and banks. So most of the sectors, the analysts have been fairly positive, and they have been upgrading their numbers as and when the actual numbers have coming up. The estimates they kept on upgrading. But for IT and banks, those expectations are not much, and that's kind of incidentally, even their valuations on a relative basis are more comfortable compared to the broader markets. And that is reasonably, that's because of the second chart which shows the index returns, where their relative return, what we have seen even in the current year or the last 3-year period, if you take, that's not as high as what we saw in the other sectors. So from a relative perspective, these two sectors looks fairly good. And from an earnings growth perspective, IT, the lead indicator, which is kind of deal wins, that have been coming fairly decent. So that could translate to revenue growth as and when the environment kind of normalizes. And we are seeing very high signs of a potential soft landing in the US, and even Fed has started talking about at some point in time to reduce the rates. So that's similar case with banks. If we look at banks, they are in a fairly good cycle as far as that bad assets are concerned. So most of the bad assets are already written off. So whatever is the portfolio is there in the current loan portfolio, they are fairly stable. And as and when the economy is picking, we would see more demand for credit, and that would ensure that they have fairly good run for the next few years. So these are broadly our market expectations. So one of the popular questions which we kind of see is, certain segments in the markets, especially as we go down the market cap, have seen stellar returns in the last 3 years, and whether that can continue in the foreseeable future. So this slide kind of answers that. So what typically happens is in an early phase of recovery, and especially after a period of difficult times like COVID and high input cost inflation, the smaller companies, you would see those margin expansion to a very large extent. The reason being, so in a difficult period, their margins could have contracted by a large margin, and they would face difficulty in terms of passing on higher prices to offset those cost inflation and things. And since we have come out of those difficult period, we saw a fairly high earnings growth in those smaller companies in the last couple of years. But if we take a 5-year view and see how that has transpired over the last 5 years, the larger companies, which are the top 100, popularly called as large cap, whatever returns that has transpired versus the earnings growth, the gap has been lower. So from a relative comfort perspective, that bucket looks slightly better placed for the next couple of years. So to sum up, so there are 3 major factors from a market perspective. One is how the valuations will pan out. The second thing is how the flows would pan out, majorly the foreign flows and the domestic flows. And finally, how the economic activity is kind of faring up. So if we look at all 3 parameters, valuations are, of course, above long-term average. And therefore, the returns from here on would be majorly driven by the earnings growth. And if we look at flows, domestic flows have been strong across period. But with a possible reduction in global interest rates, we could see those FPI flows and foreign flows kind of picking up. And most of those FPIs have a fairly large allocation to banks and IT. So these 2 sectors and the larger market cap companies could see has a better potential for returns in the coming 2-3 years. And broadly, the earning economy is doing fairly fine. And therefore, and there is some sign of even the private capex kind of picking up. So far, we have been seeing the government capex driving those capex story. And typically what happens is capex comes as a lead on a lead basis, and the consumption and the underlying economic activity picks up on a 2-3 year kind of lag basis. So all put together, it looks fairly. The environment is fairly good for a good earnings growth and the performance stock market performance perspective. So when we look at the risk domestically, things look reasonably fine. So most of the risk, or wherever we could see, of course, it's difficult to predict an event like global financial crisis or COVID, but India domestically looks favorably fine, and most things could be there could be a global slowdown because of the higher global rates, and that could impact the export-oriented sectors. That's one risk. And the second thing is, because of a lot of these geopolitical tensions, there is a possibility that commodities could remain at elevated prices, especially crude, and that could have a bearing on the Indian markets. So coming to the product portfolio where we have and how we look at asset allocation and things. So asset allocation, we feel is fairly critical, primarily because that helps you sleep well. And whenever there is market volatility, that kind of helps you in terms of getting those extra bucks by reallocating from one asset class to other. So our fundamental suggestion is you should have an emergency block and some kind of mix between equity and gold, or depending on the comfort level, you can even have some mix of debt in that. And this kind of helps, especially in a period when markets the valuations are slightly on a higher side, because whenever you get a momentary opportunity, you can switch from one asset class to other. Gold has a negative correlation with equity, and that kind of helps you, especially in times when the equity markets are in trouble or there is a global economic problem. At that point, gold tends to shine, and that helps you in kind of balancing your portfolio returns. So coming to our portfolio, product portfolio on the equity side, so our sense is as we go up this pyramid, the base is the long-term equity value fund where we focus on a value style. And as we go up, the risk kind of increases, and that's kind of indicative even of the return profile. The return goes up as you go up. The ESG fund, I'll explain that in brief in the coming slide. And that kind of replicates a growth characteristics where you have a better earnings growth, and therefore you pay slightly higher valuation. The value fund is managed in the popular value style. And we have a recent small cap fund where we, of course, pay heed to valuations, but of course there is a lot of bottom-up story happening there. So this is how the earnings trajectory of Sensex EPS have panned out over the history. If you see till FY 2021, it has been on a downhill and the earnings growth was almost flat. Whereas after FY 21, there has been a sharp pickup in the earnings trajectory. So this is a depiction of how the process have panned out in quantum long-term equity value fund. So if you see that orange line, that is based on the target prices we had. And if we aggregate that by the weights in the stock in our portfolio, you would get the predicted NAV line. And the other one is how the actual number has panned out. I'll just highlight two key things. One is whenever there is a global event like the COVID crisis in March 20 or the global financial crisis, you would see a sharp deviation there, and that's a time where you can make aggressive equity allocation. But there could be periods when it closely matches, and if the earnings growth is fine, earnings growth turns out fine, you can expect decent compounded returns over time. That's a period where the green circle is highlighted. And most likely, even coming time periods, it appears like the earnings growth could turn out fine, and valuations might sustain at the current level, and therefore you could expect reasonable compounding returns from here on. So when you look at the characteristics, the quantum long-term equity value fund, it shows the characteristics of a value fund where you have a higher dividend yield, and the portfolio valuation, which we term by the price to earnings ratio, is at a discount to the Sensex and the index. And we have ELSS fund or tax saver fund, which is managed in a very similar style. The good part about value fund is especially if you are concerned about the market valuations, value fund has an inherent risk control mechanism in it wherein you kind of buy the stock at a discount to its intrinsic value. And therefore, that risk management should be superior and it should help you better tide over in a period where you believe you're not comfortable with valuation or there is a possibility that a lot of stocks in the universe are overly valued. So coming to the ESG fund, it's popularly known as the environment, social, and governance factors. The popular notion is that the fund is built for more good for environment than for returns, but that's a misnomer. So what we evaluate here is we evaluate all the risk pertaining to all three factors, and we even have an environmentalist in our team who kind of evaluates those environment risk and things like that on a very technical way. So with this, what you essentially do is you control your risk to you have a portfolio of companies where the risk is lower than the index, and therefore those set of companies should do well over a long period of time. So since the valuation is not an entry criteria, this portfolio tends to be a set of high quality stocks with slightly higher, let's say, earnings growth, but that's reflected even in the valuation multiples and things. So coming to the small cap fund, so here our aim is primarily in small cap. Some of the challenges which we could face is, since the liquidity of those small caps is less, the capacity would be limited. So if that fund may not grow beyond, let's say, a very high market cap, and as you move above a fairly high market cap like 15, 20,000, you might, even if you take a small stake in a company, it might form a very fairly large portion of that. You might end up holding in 10% of the company or 8% of the company. So our sense is, we have a long runway in terms of managing those capacity risks to a fairly high extent, and we would be cognizant of valuations. So from a relative basis, compared to small cap universe, our valuations would be fairly fine. And over and top of those, the small cap related or the lower market cap companies risk, we've not taken any headline risk in terms of overly concentrating more than 4% weight in the company or not more than 10% stake, less than 5% stake in any single company. So that kind of helps us even in times of liquidation to realize a better value. So those were the equity products we have at Quantum. So apart from the equity products, we also have Quantum Dynamic Bond Fund, where we manage the duration or the interest rate. We do not take any credit risk. We invest only in, let's say, PSU companies and AAA rated government bonds. And we take a view on where the interest rate cycle is likely to proceed and accordingly position our portfolio. Right now, our duration is slightly on a higher side to take advantage of an interest rate fall. The duration is about more than 7 years compared to around 5 or 4 to 5 for the benchmark. And the interesting part here is, unlike past periods, if you look at the real yield, which is the yield which you get in your debt portfolio minus the inflation, that real yield has been positive, reasonably positive across periods, right from 3-year to even the longer term. And therefore, we feel the next few years from a debt investor perspective could be fairly good. So that has been from my side. Thanks so much for giving us the opportunity. And if you have any questions, I'm happy to.